Stocks are higher today, but the reason is a rumor, not a resolution. Axios reported that the US, Iran, and regional mediators are in talks over a 45-day ceasefire. The S&P 500 rose 0.5% on the news. The Nasdaq pushed to a 1.5-week high. That might sound like relief, but President Trump also said on the same day that he would blow up everything in Iran if the Strait of Hormuz isn't reopened by Tuesday evening. That's not a ceasefire. That's a deadline with a market reaction already baked in. What makes this dangerous isn't the ceasefire hope, it's what gets revealed if that hope collapses. The IEA warned that even a near-term end to hostilities wouldn't quickly restore normal Hormuz flows. Infrastructure has been damaged. Repairs will take time. Qatar has 2 LNG tankers already rerouting away from the strait. Kuwait reported refinery fires. The UAE's largest natural gas processing facility halted production after Iranian drone attacks. The conflict has already moved energy infrastructure off the map in ways that won't snap back with a ceasefire announcement. Jamie Dimon laid this out in detail in his annual shareholder letter Monday. He defended the war as necessary. Iran controlling the Strait of Hormuz for 45 years was, in his words, an unacceptable arrangement. But Dimon was blunt about the cost. He warned of significant ongoing oil and commodity price shocks, supply chain disruptions in shipbuilding, food, and fertilizer, and inflation that could run stickier than markets expect. Goldman Sachs put a number on it. Their economists now forecast Brent crude at 98, U.S. growth cut, and recession risk raised to 30% under a prolonged conflict scenario. That backdrop is what makes today's bounce fragile. 2 Fed officials, Goolsbee and Hammack, both flagged inflation risks this week, with Hammack explicitly raising the possibility of a rate hike. The ISM Services Prices Paid Index rose to a 3.5-year high in March. The White House, meanwhile, argued that productivity gains would allow the Fed to cut rates. Markets are pricing a 1% chance of a hike at the April 28-29 meeting. That number could move fast if Tuesday's Hormuz deadline passes without a deal.
Ruchir Sharma of Rockefeller International added another layer. The U.S. is the world's largest oil producer, but it's also running a nearly 6% budget deficit, the highest in the developed world. Defense spending increases, war costs, and a bond market already showing weak auction demand are colliding in a way that leaves very little fiscal room. The bond market, Sharma wrote, remains undefeated. That same macro pressure found a very specific target on Monday, Tesla. The stock dropped 3%, sliding towards 350. What's notable isn't the drop, it's that the bear case is now coming from the most credible direction. JPMorgan analyst Ryan Brinklin reiterated his $145 price target this week. That would be a 60% decline from current levels. His central argument isn't about Elon Musk's politics or brand damage in Europe, though both are real. It's about a number that doesn't lie. Tesla produced 50,363 more vehicles in Q1 2026 than it delivered. That inventory bill is larger than any prior quarter on record. Tesla delivered 358,000 vehicles in Q1, missing Wall Street's 372,000 estimate and JPMorgan's own 385,000 forecast. Production has grown 80% since Q1 2023. Sales are down 15% over the same period. The divergence between those two lines is now the defining fact about Tesla's business model. The valuation makes this harder to defend. Tesla trades at 334 times trailing earnings and 172 times forward earnings. Those multiples assume a future where robo-taxis, humanoid robots, and autonomous driving revenue eventually arrive in scale. Brinkman's argument is that investors are pricing a narrative that keeps getting pushed further out, while the underlying car business is deteriorating in ways that consume free cash flow now.
The bull case still exists. Wedbush's Dan Ives kept his $600 price target, pointing to AI and robotaxi potential. Energy storage revenue rose 25% year-over-year in Q4 2025. The Cybercab ramp is still scheduled for 2026. But the market is telling a different story. The probability that Tesla reaches $420 this month trades at roughly 18% in prediction markets. Q1 earnings, expected in a few weeks, will be the next hard test. Delivery misses become much more serious when the income statement confirms them. While Tesla and energy stocks reflected macro fear, one sector moved in the opposite direction: memory. Micron jumped nearly 4% Monday. SanDisk gained 3%. The driver wasn't new news, it was the accumulation of something that's been building for months. AI infrastructure builds are consuming memory at a pace that's compressing supply. Every large language model running at scale requires high bandwidth memory stacked directly onto AI chips. The more inference demand grows, the more HBM gets allocated to AI servers, and the less is available for everything else. That's the supply squeeze that's lifting Micron. Barron's reported separately that Apple is developing a memory architecture strategy specifically designed to navigate this constraint. The argument is that Apple's on-device AI approach, which keeps inference local rather than server-side, could insulate its products from the HBM shortage. That's a different competitive advantage than raw chip performance, its supply chain positioning. But Nvidia carries a different version of this risk. Analysts flagged this week that Nvidia's memory supply chain is facing pressure as HBM capacity gets absorbed across the industry. Nvidia's chips are the primary consumers of HBM, which means any tightening in HBM supply creates a production bottleneck at the top of the AI stack. The China dimension adds complexity. Chinese competitors are pushing into the AI chip space, accelerating demand for HBM globally, while also pushing Nvidia's customers to consider alternatives. The memory trade has a forward condition. If AI infrastructure spending holds, and the major hyperscalers have all signaled 2026 capex increases, demand for HBM stays tight. If the Iran war's economic drag causes hyperscalers to delay capex, the memory rally stalls. Goldman Sachs' 30% recession risk estimate is the number to watch. At that probability, discretionary capex becomes a real question, even for companies with strong balance sheets. The three threads of today's session converge on one variable: how long the Iran conflict lasts. A short war with a credible ceasefire leaves the Fed on hold, Tesla's execution problems as the dominant story, and memory stocks as the clean AI trade. A prolonged war that pushes oil toward 150 reroutes everything. The Fed faces a genuine rate hike decision, Tesla's high multiple stock becomes nearly impossible to defend, and even hyperscaler capex comes under pressure. The ceasefire talks reported today are real, so is Trump's Tuesday deadline. The market moved on hope. The fundamentals are still waiting for resolution.